Thanks to the markets being so accessible, traders can trade a massive range of currencies, including major pairs, minor pairs, and even exotic pairs. With all these choices, it can be difficult to choose which pairs you should be focusing your time on as a trader. To make things more complicated, many strategies will work on some currency pairs, but not to be profitable on others. In this video, we'll look at exactly which Forex currency pairs you should be trading and why. So with no further ado, let's get right into it. And don't forget to like and subscribe to the channel. So getting started here, in Forex trading, strategy selection is incredibly important. However, currency pair selection is something often overlooked by traders, despite it being equally critical. There are many strategies that will work on specific currency pairs, but be entirely unprofitable on others. If you were only trading the unprofitable pairs, you'd believe your strategy was not profitable. If you are trading both profitable and profit currency pairs, your results will be diminished by the losses on the unprofitable pairs. Therefore, knowing how to select a great trading pair for you and your strategy is essential. Largely speaking, the British pound US dollar and the Euro US dollar are regarded as the best Forex pairs to be trading, both for advanced trading and newbie traders. There are several reasons for this. These pairs are very high in trading volume. This means there will be a lot of trading opportunities on all time frames. Both pairs have incredibly low spreads regardless of the broker or prop firm that you work with. Both of these pairs often trend. They go through regular market cycles of ranging and trending markets. So both GBP USD and the Euro USD frequently have economic news, meaning periods of consolidation don't last long and many opportunities are presented by looking at the economic data alongside technical analysis. Typically, if you have a profitable trading strategy, it will be profitable on these two pairs. There are exceptions to this rule, but testing with these currency pairs is always a good starting point. Many of our funded prop firm traders utilize these two currency pairs as part of their portfolio. So what makes a good Forex currency pair? Well, a good Forex pair can be identified by these following traits. 1. Low spreads. Low spreads are incredibly important for intraday traders, scalpers, and day traders. It's difficult to remain profitable for intraday traders if you're paying multiple pip spreads on every trade. Then trending markets. Good Forex pairs are usually trending by nature, not constantly trending, but go through the usual market cycles of ranging and trending. And then the frequent economic news is a sign of a potential good Forex pair to trade. Pairs with no economic news typically stagnate and consolidate. And then we have high trading volume. Usually good Forex pairs will have a high trading volume per day, which can present great trading opportunities and profitability with your strategy. So most importantly, if a trading strategy is profitable on a certain currency pair, then it's a good pair for you to be trading. And what makes a bad Forex pair to trade? Well, high spreads. Large spreads can make it difficult to profitably trade a currency pair. This is less important for position and swing traders. Low trading volume. With low trading volume, spreads will be larger and moves within the market will be less frequent but more aggressive. This can make it incredibly hard to profitably trade these pairs. And we have unprofitable with your strategy. Any pair that doesn't work for your strategy is a bad pair. Just because you aren't profitable in a test on one pair doesn't mean your strategy isn't profitable on others. Consolidating constantly. Many exotic and minor currency pairs consolidate or range constantly, providing very few trading opportunities. For example, the Euro Swiss franc is known for moving in ranges, as well as the Australian dollar and the New Zealand dollar. So continuing here, ultimately, you can trade any Forex pair. What you need to be certain is whether your strategy is profitable on the other currency pairs. Many trading strategies that require high levels of trading volume will not work on exotic trading pairs. For example, if you're scalping or day trading, you need to access to extremely tight spreads. You're going to see much larger spreads on currency pairs like miners and exotics due to the decreased trading volume. This will render these pairs unprofitable for the large majority of the intraday traders. So how do you know if your strategy is profitable on a specific trading pair? It comes down to testing. If possible, you want to be back testing your trading strategy objectively on as many pairs as possible, gathering as much data as you can. By doing this, you may be able to expand your trading strategies to trading a portfolio of 7 pairs rather than just 2, for example. Providing you can trade these currency pairs simultaneously, you should increase your profits by doing this. It's worth caveating that point by mentioning that trading heavily correlated pairs at the same time will greatly increase your risk. For example, selling the British pound US dollar, the British pound Swiss franc, the British pound Australian dollar, and the British pound New Zealand dollar at once increases your risk 4 times. Even though your strategy may be profitable on these pairs, this is still a massive risk to consider. In conclusion, the best Forex pairs to trade are currency pairs with high trading volume, frequent economic news, typical market cycles of consolidation and ranging markets, low spreads, and most importantly, profitable with your specific trading strategy. That's going to be all for today. I hope you've enjoyed the video. If you have, please like and subscribe to the channel. And as always, be safe out there.